What is up, guys? Your agent Tyler Wayrung here, and today I'm going to be giving you an update on my investment with Open Door Capital's fund into the Heights on Katy apartment building. If you're not familiar, if you want to see my full story on how I got started investing with Brandon Turner and his company Open Door Capital, check out the link up here to see how I originally got started with his first fund. We did start out in Fund 1, then rolled all of that money into his next fund, which was originally called the Chevelle Apartments, rebranded to be Heights on Katy. But today we're going to be giving you an update on how that investment's going with everything else going on in the market right now. And it's actually not super great, but want to kind of share the good, the bad, the ugly, just like they do, and just keep you guys updated on how this investment's going. So I'm going to share with you 2 newsletters that we got and talk about my perception of it. So with that, let's go. This was our update that we got right towards the end of 2022. This might have been the December update, actually November update. So they always start out giving you, some general company overview on how the investment's going, and then you get into your specific asset. So like I said, this one is Heights on Katy. So financial performance ended at 91% overall occupancy. They had some evictions, some non-paying units. They did see some higher than normal bad debt expenses. But let's look here at over/under projections. So this is the number I look at a lot, is how far we are at our projections. So the investors, the limited partners like myself, our return is based on their original projections. So if they're under their projections, that means our returns are not going to be as great. So like I said, we're just in year 1 here. So obviously you can't really speculate how this is going to end up down the road, but they are under from an occupancy, revenue, NOI, and year-to-date NOI perspective. Not looking great, honestly. So the good news is they, in the beginning, they were planning to do lots of capital expenditures, and they talk about that a little bit in here. They're doing some new landscaping, new monument, new pool, restaining the tennis court. So lots of stuff. Also upgrading 5 to 10 upgrades per month, kind of turning those kind of older units around. So do just share some random pictures here. Could get a better photographer. The lighting's pretty bad in these pictures, but nonetheless, you can at least see, they truly are making some significant upgrades. Package pickup area, this is super cool with a nice branding on that. But the parts we really care about, distribution update, and this is where things got a little sour towards the end of last year. So we are planning for a temporary slowdown in distributions during Q1. Over the past year, our overall note payment and insurance costs increased much higher than initially projected. That said, when we closed the property, we did purchase a tight rate cap, which continues to protect us from runaway debt costs. In November, this rate cap covered $76K of the $280K, but over the past year, it has risen by $50K. So what that means is they did get some form of variable note, or some note that floats with the overall macroeconomic interest rates. So with the, everyone else's rates going up, it sounds like theirs is going up as well. They did buy a little bit of protection into how far that could go up by that rate cap, but at the end of the day, this is much more significant than they expected. So can you really get upset with them? I don't know. I don't like variable rates, and I'm a little surprised that they took on that risk with this big of an asset. But, at the end of the day, I trust these guys to do what's right, and it sounded like they had some mitigation or stop gaps in there. So let's continue on. Additionally, across the Houston market, insurance costs have swelled in response to recent natural disasters and freezes. I think everybody saw that. Obviously, not something you can prepare for. No one in the city was prepared for it, but these insurance companies are coming back to be prepared the next time around. So they're now charging for the higher probability of something like that to happen again. We see this across the United States anytime natural disasters are hitting. So to lessen further stress on performance, our management team is first expediting plans to boost revenue and reduce expenses. This one to me was like, I'm kind of just like a little, why weren't you already doing this? And then what other plans can you do? You can't just boost revenue and reduce expenses. Obviously that's what everybody would do if the options were there, right? So you only have certain levers that you can pull on. So I don't know. To me, this one is kind of just like a, hey, we're doing something, but the fact that this triggered you to boost revenue and reduce expenses, like you should have already been doing that. So that was a little, I don't know, that didn't sit great with me. But secondly, we're planning to build reserves through a slowdown in distributions over the months ahead. We do not take this decision lightly. We are working to keep distributions consistent while prioritizing your investments long-term health. So this one really doesn't bother me. You don't not get this money because they're not distributing it. So you still are entitled to how this property does. So if they let it bank up for a couple months and then give it to you, you're still in the same position. And at the end of the day, this is a long-term hold, I think 5 to 7 year hold plan. So again, this is a conservative approach. This is the approach I would have taken in this same position. You never want to get in a position where you don't have reserves to cover something that comes up. So while it's never an easy decision to not distribute funds, in this case, with everything above, I thought, hey, it's the right decision. So, but let's go into, this was the December update here, and I'll jump to the parts that are more relevant. If we look at financial performance, things did get a little bit better in December. I'll actually look at these side by side just to compare. But you'll see, things are progressing in the right direction, at least from an occupancy, revenue, NOI perspective. Just slightly better on year-to-date NOI, but obviously that's just 1 month ahead, so you can't really impact that number a whole lot. So that's the positive note I took out of this, is we are back to trending in the right direction at least. Income and occupancy climbed as we won leases in higher markets. We stabilized bad debt, non-paying eviction tenants now in the single digits. Maybe they executed their plan to expedite increasing revenue and decreasing expenses, and I'm just not in the loop there. Payroll also increased slightly this month with 3 pay periods. We stayed on pace for the year. 10 units were affected by the recent freeze, which is good. I think this is 350 units, so that's a very low number of units impacted overall. Property updates continue. Yeah, these are just continues from the last month. Then they touch back on the distributions. Hey, after careful considerations of where we are in the market, significant run-up costs around mortgage rate and insurance, obviously nothing new here. We decided to focus on CapEx for the time being, just in unit upgrades and above-mentioned projects are already in flight, essentially. They're working on those. They don't really make sense to stop them. However, it sounds like some of their other bigger projects are on hold as well, until we have a better handle on what this is going to look like. They actually did distribute the full amount in January, which I actually wasn't expecting based on the December report. All right, this will go into effect in February. We're in unprecedented times, and we feel it's best in the interest of your long-term. Okay, so let's talk about how I perceive this update. So obviously, like we touched on before, it's not great. You would prefer them to keep making distributions, and you prefer to everything just goes smoothly. However, things do come up. I totally understand that. But my big question now is, if rates are one of the big pieces in this puzzle that's causing you to be behind projections, the rates don't look like they're coming down anytime soon. So what does this look like for the next several years of this investment? Did you really underwrite this at a position where rates were going to stay the same, which is not something I would have expected from this team? And I'm surprised at the lack of fixed rates to protect that, or to kind of be more conservative in this approach. So me being on the sidelines, it's easy to just point fingers and, say you should have done this, should have done that. I'm not going to do that. I'm still confident in this team. I think we'll still be able to turn it around and turn this into a positive. But yeah, I guess those are just some of the initial questions that came to my mind when I was reading this, and a little unsure about what the next couple years might look like. So those are just my thoughts and my initial perception around these last 2 updates. So drop your thoughts below in the comments on how you would feel if you were in my position, or if you are an investor in the Heights on Katy's, a limited partner with myself. Let me know how you're feeling about this recent past couple of updates and putting things on pause because of the reasons that they outlined before. Again, super confident in this team, but I don't see the 2 big issues that came up going away anytime soon, and that's where my hesitation is. But guys, if you did find this helpful at all, or you want to continue to see updates on this investment, hit that like button below and let me know in the comments. Sharing this video also is a free way to support the channel and lets other people know, and YouTube, that this video does provide value and it might be worth watching for other similar viewers like you. So with that, guys, we'll go ahead and wrap. I'm Tyler Waverung, and we'll catch you next time.